Good morning. We have a critical decision ahead of us today. The economy looks stable on the surface, but beneath that calm, we see structural pressures building that could break suddenly. Let's begin.
So right now we're sitting in a transition zone, not in some clear expansion, but not contracting either. Recent growth has been driven by two temporary supports, declining imports and resilient consumer spending. Both are beginning to take momentum. Imports have fallen largely because firms front-loaded shipments in anticipation of new tariffs. That artificially boosted GDP in the short run, but that effect is fading. On the other hand, consumer spending still looks solid, yet it's increasingly financed by depleted pandemic-era savings and rising credit usage, which is not sustainable. So while the headline numbers show above-trend growth, the underlying fundamentals are softening. We're not in a recession, but the economy isn't on a steady expansion path either. It's more of a late cycle environment where momentum masks emerging vulnerabilities.
To ground our policy recommendation, we built quantitative models using FRED data from the St. Louis Federal Reserve. We looked at indicators like core PCE inflation for year over year, the unemployment rates, and the natural rate of unemployment to form an unemployment gap that we call slack, the GDP, real GDP, and also past effective FFR rates from the Federal Reserve. From this data, we estimated two complementary approaches are based around the Taylor rule. First of all, we have implemented an LLS dynamic Taylor style rule with policy inertia, and also a machine learning nowcasting pipeline using elastic net and gradient boosting with decision trees to predict next month inflation and slack, which we then map to the Taylor rule. Both our models predict a range of 4.25 to 4.5%, centering around effective FFR of 4.4%, which is really similar to the prediction from the current Federal Reserve of 4.33%. However, current economic conditions can cause deviations from this baseline, which is governed by two main approaches in terms of inflation and unemployment that we will look into in terms of the macro conditions affecting deviations.
So let's turn to inflation. We've identified sector-specific dynamics shaping the path towards our 2% target. Current CPI is around 2.5%, with models projecting a modest rise to 3.2 to 3.8 by October 2026, driven by compositional shifts and potential policy headwinds, not a reversal of disinflation. Medical care inflation spiked above 8% in 2022 before moderating near target. Shelter inflation remains elevated around 5% as lease renewals catch up. Transportation has normalized after pandemic disruptions, and food prices have cooled from 13% to roughly 2%. Tariffs introduce upside risk, directly pressuring goods and indirectly affecting services like housing, healthcare, and education. Overall, inflation is moving toward target, but the path is uneven. Now let's look at the softening housing market. This chart provides perhaps the most encouraging evidence for continued disinflation and highlights a critical measurement challenge. Notice the dramatic divergence. CPI shelter inflation remains elevated around 5%, but market rents from Zillow and Apartment List have been flat or negative for over a year. Actual market conditions show deflation, yet CPI shelter registers significant inflation. This isn't a data error, it's a structural lag. CPI shelter reflects all existing leases that renew gradually. Market rents capture new leases in real time. Given typical 12 to 18-month lease cycles, CPI shelter would mechanically converge toward flat market rents over the next year. Since shelter represents one-third of CPI, this pipeline effect will exert substantial downward pressure on headline inflation. It's already baked in. For monetary policy, this means the lagged effects of past tightening are still working through the system. Shelter will transition from an inflation driver to a disinflationary force, which counsels patience and data dependence rather than maintaining unnecessarily restrictive conditions.
A critical question to be considered is whether tariffs will trigger a significant CPI spike. Our analysis suggests no for two key reasons. First, the transmission mechanism limits immediate impact. Import price inflation typically leads CPI by 6 to 12 months. Tariffs cause an immediate spike in import prices, but CPI responds gradually. This represents a one-time price level increase, not persistent inflation. The distinction matters. Tariffs raise prices once, but don't generate ongoing inflationary momentum absent subsequent shocks. Second, demand constraints prevent large price increases. Consumer spending is currently strong, but aggregate demand cannot rise enough to absorb substantial price hikes. We're already observing moderation in retail sales and increased price sensitivity. This limits firms' ability to pass through tariff costs fully. While immediate CPI spikes appear unlikely, longer-term persistence depends on inventory dynamics and corporate pricing decisions. Companies stockpiled goods ahead of tariffs, creating a buffer which insulates consumers from price increases. When inventories deplete, firms must decide whether to pass costs through to consumers. However, current inventory levels remain elevated, approximately 15% above pre-pandemic averages. We estimate this cushion lasts through mid-2026, meaning we do not expect substantial price increases in the short run. Beyond mid-2026, the inflation trajectory depends on macroeconomic conditions at that time. If demand has softened as we forecast, given moderating consumption, slower hiring, and accumulated household price sensitivity, competitive pressures will constrain firms' ability to raise prices. The inventory buffer effectively delays tariff transmission, providing time for demand-side conditions to evolve and potentially preventing persistent inflation even as buffers deplete.
So global conflicts have disrupted supply chains and driven up energy and food prices. But prices have fallen from the peaks as the markets have adjusted. So stabilizing commodity prices are easing inflation pressures. Now, geopolitical risks remain a key factor, but the tail risk has diminished significantly.
We also wanted to understand where expectations are trending, because even if inflation itself isn't set to rise, if people think it will, that can become a self-fulfilling prophecy. We looked at this in two ways. First, through the stock market. While markets aren't the economy, they are an expectations machine. They show how people feel about growth and demand, and the S&P and Dow have both rebounded from their dips after Liberation Day, suggesting renewed confidence in businesses and prices holding up.
But aren't markets sometimes too optimistic? Stock prices could just be reacting to profits or AI, not inflation.
True, markets can be noisy. That's why we paired this with sentiment data from Blue Sky to isolate inflation concerns. Both indicators show the same story. Confidence has improved, and inflation fears haven't reaccelerated. On Blue Sky, mentions of inflation fears spiked after major events, like Liberation Day, but have since moderated, and that lines up with the data. 1 year ahead expectations rose slightly to 3.4% from 3.2%, and 5 year ahead to 3.0% from 2.9%. So overall, expectations remain anchored.
Here's our overview of inflation. Overall, here's what the inflation data is telling us about the appropriate policy stance. First, inflation is moderating. Core CPI and PCE show slow, steady month-over-month gains, consistent progress towards our 2% target. Tariffs create near-term pressure on goods prices, but we assess this as transitionary. Consumer spending cannot sustain large permanent price increases. Demand elasticity will limit pass-through. Third, inflation expectations remain firmly anchored. This prevents the self-reinforcing wage price spiral that characterized past episodes.
Let's take a clear look at the post-pandemic labor market. These four charts tell a consistent story. The job market remains strong, but momentum is starting to cool. In the top left, we see unemployment at 4.3%, which is up from the post-pandemic low of 3.4, but still below the typical 5.5 to 6. That means the market is tight, even as hiring slows. In the top right, we see total employment has reached record highs as the economy fully recovered its pandemic losses. In the bottom left, we see that payrolls have grown from about 145 to 158 million, adding roughly 13 million jobs since 2020. And finally, in the bottom right, we can see that the labor force participation is resilient, but it is normalizing. So the big question now is this just a healthy cooling after a rapid recovery or the start of deeper softening?
Now, here are where things get interesting and honestly a bit unusual. We're seeing what I like to call a frozen labor market, characterized by low firing and low hiring at the same time. If we look at the top left chart, aside from the COVID spike, we're back to historically low levels of layoffs and discharges. Firms aren't letting people go. But on the top right, we see that hires have also fallen sharply from their 2021 to 22 highs and remain weak. Companies aren't adding workers either. The bottom charts share the same story. The quit rates have normalized, fewer people are voluntarily leaving, and job openings have dropped from those overheated pandemic levels. What this tells us is that firms are hoarding labor. They remember how hard it was to hire during the pandemic, so they're holding on to workers. But they're also hesitant to expand given costs and uncertainty. The concern, when cuts finally come, they might happen all at once, not gradually.
But if companies aren't firing people, why is unemployment rising like we saw earlier?
That's a great question. The rise in unemployment isn't from layoffs, it's from new and returning workers who can't get hired. Plus, job seekers are staying unemployed longer because firms aren't actively hiring.
So this brings us to the key question, are we actually headed for a recession? On the left, we have the SOM rule. Unemployment has climbed from 3.4% to 4.3%, not officially triggering the rule, but we are getting close. If the trend continues or accelerates, it could tip us over quickly. We have to consider that the average is moving up. On the right, we have the yield curve. Recently, it's just turned positive again, around 0.1%. For example, the 10-year yield is now at about 4.3%, and the 3-month around 4.2%. Historically, recessions tend to begin after that normalization, not during the inversion itself. The market's message is clear. It's pricing in a slowdown and future Fed rate cuts.
Wait, why worry after the curve normalizes? Isn't that a good sign?
The inversion reflects expectations of weaker growth ahead. The uninversion is where those expectations start to play out in real data. Right now, we're at a really rare convergence. Unemployment is creeping towards the SOM rule threshold, a yield curve that's just uninverted, and that frozen labor market we discussed earlier. None of these alone confirm a recession, but together they're flashing caution. The big question now is whether the Fed cuts proactively or reacts once the shutdown's already here.
Now let's look at tariffs and higher input costs. Tariff policy is aggressive, and we'd assume, seeing is that this no fire trend is masking growing cost pressures beneath the surface. The most exposed areas are manufacturing, transportation, and retail, especially firms relying on imported goods. Right now, they're cushioned by existing inventory buffers, but as we discussed earlier, those typically run out within 6 to 9 months. When that happens, companies face a binary choice. Option 1, pass higher costs onto consumers, but with demand already stretched, that risks serious demand destruction. Option 2, cut payrolls to protect profit margins. And most firms will likely choose option 2 because of the frozen labor market, employment could contract sharply once the pressure breaks.
We can also consider the really aggressive immigration policy. The direct effect is straightforward. Reduced immigration tightens the labor supply in sectors like agriculture and construction. But there's also a hidden effect. Every immigrant worker supports roughly 1.2 additional jobs through complementary demand. That person's renting an apartment, taking public transit. So when you remove that worker, you're not just cutting labor supply, you're removing the demand that worker created across the economy. And on top of that, when more low-skilled jobs are filled, it actually creates demand for higher level positions too. Think managers, supervisors, staff. The whole employment structure depends on the base layer of labor. So this is actually a demand shock disguised as a supply shock, and it helps explain why unemployment could rise faster than simple labor models predict. Lastly, we can consider automation. Investment is at an all-time high right now, meaning that we're quickly seeing what AI systems, robotics, etc., being used on a commercial scale now, not 5 years from now. Since 60% of US workers lack 4-year degrees, these workers are in automation vulnerable sectors. Black and Hispanic workers are overrepresented in these sectors, meaning it's not just economic, it's an equity issue. Deployment would scale in the next 12 to 24 months, but workforce retraining takes years. By the time retraining scales, displacement will have already happened. Policy needs to cushion this transition period. So to look at the labor market broadly, we're in a very tight but vulnerable position. Unemployment is near historic lows, but hiring is slowing, meaning we're at a possible tipping point. With structural pressures building, like automation, tariffs, and immigration, we don't know what we should do, and it weakens labor demand. Policy should cushion, not cool, and a modest rate cut could stabilize demand and prevent sharper downturn.
Given everything we've analyzed, let's circle back to the ML model predictions. We propose a revised FFR of 4.25%, 15 basis points from the baseline, and 8 basis points down from the current FFR policy by the Federal Reserve. We implemented this through the nominal policy rate and predictions of the neutral real rates, in addition to considering macro conditions, as mentioned.
I want to push back here. Inflation's cooling. It's not the problem anymore. The problem is jobs. Housing disinflation's already baked in. Energy prices are steady. We've got at least 50 to 75 basis points of automatic disinflation coming down the pipeline. We have room to act.
But Tulsi, a 50 basis point cut sends a signal of panic. Inflation expectations may be stable now, but they're still fragile. We can't afford to unanchor them again when disinflation is already happening gradually and it's not fully secured.
But it's not panic, it's leadership. The country's hurting. If we're wrong and inflation ticks up, fine. We'll tighten again. But if we're wrong on employment, if this labor market cracks, there will be serious consequences.
I get that, Tulsi, but a big flashy cut risks shaking that trust when we're so close to a soft landing.
I'd like to add that the yield curve has finally normalized after 2 years of inversion, which means that financial conditions are easing naturally, and moving too fast could undo that stability.
There's truth in what you're saying, but the balance sheet gives us a middle path. Short-term asset purchases can support credit markets without sending a panic signal through rates, helping small firms without undermining expectations.
Fine, as long as we're actually making a change. People don't need promises. I just want to make sure we're actually taking action.
Exactly, and that's why our final stance keeps the rate steady but adds targeted liquidity. It's steady policy with flexibility if things worsen.
Our final recommendation is to maintain the federal funds rate at 4.25%, paired with short-term asset purchases to support liquidity and ensure an orderly expansion. The reasoning is inflation continues to moderate, and there's a clear disinflationary pipeline in the housing market already in motion. The recent tariffs are a one-time shock, not a sustained inflation driver, and importantly, expectations remain anchored, and we're not seeing a resurgence in inflation psychology. On the labor side, risks are asymmetric. The market looks stable on paper, but it's frozen beneath the surface, and when it breaks, it could break fast. Tariffs, immigrations, constraints, and automation are all interacting in ways that could strain labor dynamics. And finally, there's the equity dimension. The people who are most exposed to these layoffs and shocks are the least able to absorb them, so maintaining support helps prevent deeper long-term scarring. Let's move to a vote. All in favor?